Welcome to the Generational Investors Podcast, where we explore the timeless principles of building lasting wealth. I'm your host, John Woodard III, and this week I'm here with a new guest, one of our very well-trusted advisors, Mr. Todd Senter, CFP, Certified Financial Planner. He's been with the firm for a good few years now, long time here. Instead of going into details, I'll let him just introduce himself a little bit.
Yeah, it's great to be here, John. I started with Woodard & Company back in 2004. Your dad hired me. I was working for Auto Owners Insurance Company. Had been there for about 8.5 years, and was not particularly thrilled about the prospect of moving to Michigan.
I would not either.
Yeah, and so Woodard & Company was experiencing a pretty tremendous amount of growth at that time, and so your dad offered me a job, and I took it, and it was a career move, and so it was great, and it's been great, and it's been a wild ride, but it's been a fun ride, all in all. The markets are never boring.
Always something going on.
There's always something going on. Yeah, so that's a little bit about me.
That's good. Getting into the episode today, we're going to be talking about 401k plans, what exactly they are, and how they're especially helpful just getting started early, young, and just as soon as possible. So I'm going to be asking you here just a load of questions, and
sure.
we'll dig right into it. But first off, just tell the viewers here what exactly a 401k plan is.
Yeah, so a 401k plan really, and most 401k plan is basically an employer-sponsored plan where the employee can participate and make tax-deferred contributions, typically to a retirement account. And a lot of the times, the employer will also make a contribution on behalf of the employee, and so it's a very fundamental part of most benefit packages. And when you hear people say, like us, when you hear us say, 401k, pretty much the same rules apply to the 401k, 403b, 457, thrift and savings plans. The U.S. government's thrift and savings plans, things like that. All those are tax-deferred, typically tax-deferred employer-sponsored plans that the employees can participate in and contribute from their paycheck.
And 403b and the other ones would be from what specialized institutions?
Yeah. So 403bs a lot of times. So 401ks would be like just a publicly held company might have a 401k plan. Education facilities, medical facilities, a lot of times will have the 403b plans. The 457 plans, the thrift and savings plans, you see a lot with the government.
Okay.
Any type of government job is where you're going to see those typically.
Gotcha.
So yeah.
And so
all of them have very, very similar rules. When you look at the rules and the contributions limits and things like that, it's pretty much the same.
You mentioned it kind of briefly, but when people are saying that if you're investing money in a 401k, you might get free money from your employer, what exactly does that mean when people say that?
Yeah, free money. Who doesn't like free money, right? Free money is this. When you participate in an employer-sponsored retirement plan, a 401k, we'll just use that, your employer, you need to find out if they have a match. And a match would be something like they will contribute 50 cents on the dollar up to the first 3% of what you put in, of your pay, of your salary. And so, or it maybe it's dollar for dollar. You really don't know until you ask. Mm-hmm. But typically they put a cap on it so that they stop the match at 3% or 5% or 6%. It doesn't matter. But wherever the match is, that's your first goal is to participate enough to at least get the match. Because that, if you don't, let's say the match is 6% and you're only doing 3%, where you're leaving money on the table. Or let's say you have a match, but you don't participate at all. You'd rather keep that money, and go spend it on the weekend. Well, then you're leaving, 3%, of your salary or 5% or whatever the match is on the table. So that's the free money. When you hear us talking about free money, that's what we're talking about. You don't want to leave the match on the table. You want to do at least enough to get the match from your employer.
So that's goes into the next question. What should someone be aiming for? Is there a certain amount, or just you say that just starting off trying to get what the minimum is for the contribution match? I'm assuming.
Right. No, that's a good question. And so really what we're talking about here is not so much the person that's been participating in the plan for many years, but really your beginner, your 25-year-old, whoever just out of college as soon as you're eligible, or maybe maybe you didn't start saving for retirement soon enough, and or earlier than you wanted to, and so maybe you're like 35 or 40. That's okay. Doesn't matter when you start the plan. There's no time like the present, right? Yeah. And so when you're in those beginning stages, maybe you can't do out of your paycheck. Maybe you can't contribute a full 6%. Well, start with 2%. And then if you get a raise next year, you get a cost of living adjustment or something like that. Let's say it's 3%. Well, give yourself a 2% raise, but then you give your 401k a 1% raise. And then the next year do the same thing and the same thing. And then before you know it, you will have grasped that entire match. Yeah. And it might take 2 or 3 years or something like that. But that's no problem. I mean, saving for retirement is not it's not something you do overnight. It's something that takes some time, and that's one of the reasons why the 401k plan is so great, is because it allows a person an entry level vehicle to get into investment and invest in a way that is planning for their retirement. You can't withdraw from it until you can withdraw from it, but you can't take money out of it without a penalty until after 59 and a half. Because see, your money goes in pre-tax, typically. It goes in or tax deferred. So you're not taxed on those contributions that go in
until you take it out.
Until you pull it out, and then you pay ordinary income taxes, just like a paycheck. So if you pull it out before 59 and a half, there's a 10% penalty. If you wait till after 59 and a half, you just pay regular income taxes.
Okay. And so a lot of people try to time the market a lot, and in certain times, such as in 2008 or in the Trump's Liberation Day back last year. I mean, it could have paid off very well when the stock market was down 20% from its highs. But do you think it's more so time in the market or timing the market for what people say?
That's a great question. Tell me when those downturns are going to be, and I will tell you to time the market. The problem is we don't know when those are going to be, right?
As you always say, 20/20 hindsight vision.
Exactly. So it really, the second part of your question, it's time in the market, right? It is, if we know that the U.S. stock market has an average annual return of 10% over the last 100 years, ballpark. And so when you think about your 25-year-old starting out, and you're making, who knows what you're making per year, but you're at an entry-level salary. Maybe all you can do is $50 a month, right, out of your paycheck. But you put your $50 a month in, let's back it up. Let's say $50 a week. Let's say you get paid weekly, and you put $50 a week in. $50 a week for 40 years till you're 65, and you compound that at an average annual return of 10%, which would mean you would be in the stock market the whole time.
The whole time, yeah.
And your returns average out to about 10%. If all you ever did was put $50 a week in, you're going to have somewhere around $1.4 million
That's unreal.
when you're 65, and so that's time in the market.
Anyone can do that too. I mean,
Right.
that
That's
doesn't
50
matter. Yeah, it's $50
right.
a week.
Exactly. So that is also what we call the magic of compounding interest. Because hopefully listeners have played around with some of these calculators online and things like that, and you can go run some time value money calculations. And so you can run these scenarios and say, well, how much do I need to save at this rate of return to have this amount when I'm 65, no matter what your age is, whether it's 25, 35, 45. So the sooner you start, you have more time on your side. You have more time for the money to compound, for the interest to compound. This is a situation where interest is your friend,
Yes.
not your enemy. Interest is your enemy on credit cards that aren't paid off and consumer loans and things like that. That's where interest is your enemy. You want to participate in a 401k plan or retirement plan because interest is your friend there.
Thank you. And actually, just one other example that I read in one of the books from Tony Robbins that I like is the difference between starting early and later down the line in life is someone who put in $5,000 per year, which is about twice as much as what you're saying, between the ages of 18 and 28. So 10 years, $58,000 or $50,000. They didn't contribute another dollar from 28 until 65. That turned out to be about $1.1 million by the time they came to retire, 10%, the average market rate return, versus someone who started investing at 28 and went all the way 65. And that's 37 years, and they start put down $5,000 again in each one of those, which turned out to be $185,000. They ended up only having still a good amount, but $900,000 at the end. So the person that started earlier and invested way less ended up having $200,000 more, and they invested $135,000 less. And that just shows the power of starting early. And that's the powerful thing of it. And so when you think that, yes, of course, the best day to start investing was 20 years ago, but the second best day is right now,
It's
today.
right now. It's today. Yeah.
Just small little chunks really add up, because it's in the grand scheme of things that adds up, and it.
Yeah, it's great. And most 401k plans, you're limited to the investment options inside that plan. There's good ones, there's bad ones as far as investment lineups, but typically all of them will have some sort of index fund, some sort of target retirement date fund. I'm not a big fan of the target date funds. I would prefer just a straight S&P 500 index. If I was starting out and my plan had $0, I'd probably put it in the S&P 500 if it was me and just let it go. Depending on your investment options. And that's something that we help people do. We'll help you sift through your investment options and decide what's the right allocation for you. But typically, if you're starting out, that S&P 500 fund or total market index, a lot of times is what it's called.
Yeah.
Those are good places to start.
So when you're going into the investments, what makes it important to stay invested in those market downturns?
Yes, that's a great question. So, if you think back to any of the downturns that we've had, I started here in 2004. Obviously, 2008 was a big one. 2008 started a downturn in September that year. Really is when it started to cascade, and the market sold off 56%. And that was the biggest decline in the stock market since the 1929 crash. The 1929 crash was 89%. But then the market rebounded, and then it went on from there. Longest bull market in quite some time, if not history. I have to go back and check that stat. But then, COVID hit. And during COVID, we had a 36% decline. But a 36% decline in about, 5 weeks.
That's
early 2020. And then the market rallied off of that, and by 4th of July, the market was back up even with where it started the year on January 1.
That's a quick rebound.
Pretty quick. Your dad kept saying, this reminds me of 1987, and in the 87 crash in October. That was back in 2022 where the stock market, where the Federal Reserve started raising rates. because inflation had gotten out of control. Inflation had gotten up to the highest level since the early 80s. And so the Federal Reserve comes in, starts raising rates, the market sells off 26%. And that sell-off started in about March, and it lasted until October.
That's a little bit more of a just grieving one compared to the other ones.
So you got 56% in 08. You got 36% in 2020. You got 26% declines in 2022. And then you get an occasional 5% pullback or 3% pullback, a 10% correction, a 15% correction. Last year on the tariffs, when President Trump announced the tariffs, the market sold off roughly 20% between March, April area. So why is that important? All that to say, the reason is to answer your question, right? You would much rather be buying dollar cost averaging from your paycheck through those market downturns, because why? You're buying it on sale. It's like going shopping the day after Christmas. And if you're going to buy Christmas lights, do you want to buy them on before Christmas or the day after Christmas?
Day after Christmas.
Right.
They're on sale.
Yeah. So same thing with the stock market. When the market's down 15%, it's a great time to buy. A lot of people stop their contributions, but
The fundamentals stay the same for the stocks,
man.
but
And
it's
you're buying more shares. You're able to buy more shares because they're on sale. They're on sale 15% or 26% or 36%, or in the case of 08, 56%. The people that did the best in 2008 are the people that stayed in the market. And, when they got this, I've heard this a million times, not a million times. I've heard this hundreds of times. The people that did the best in 2008, the clients that did the best are the ones that I didn't even look at my statement. I just put it in the file cabinet.
smart.
And they just
it would not have been pretty.
They just stayed in their plan. They stayed in their 401k plan. Yeah.
So I guess piggybacking off of that, what do you think people who are nearing retirement would say? Have you heard what their biggest regrets would be about just coming into 401k's or retirement plans or anything of that sort?
Wishing, the general statement really is, I wish I had started sooner. And sooner doesn't mean 25 in every case. Maybe it's 35, maybe it's 45. But you can't be closing in on 65
and decide,
I'm going to start saving for retirement. You kind of missed the boat by then.
Unless you're going to retire by 95 or so.
Yeah. And so that's probably the biggest.
Okay.
And we're talking 401k's. There are so many different retirement plans available out there. And most employers do have some sort of retirement plan in place that folks can participate in. And
that'll be the last question, but leading to that one, I guess reversing back to ages here, what advice would you give to someone who's 25?
25 years old, if you're assuming you're employed, right?
I'm fresh out of college.
If you're not employed, get a job.
That's a good one.
That's a good place to start.
So fresh out of college, just got my degree.
Yeah.
And I'm a year and a half into the job.
Yeah.
What would you?
So my advice would be, okay, how much do you have for a match? What does your employer match for your retirement plan? What kind of retirement plan do you have? How much do you get in a match? Start there. And then look at your budget. We always, I'm a certified financial planner. I like to have emergency money tucked away on the side for emergencies. Make sure you've got a little bit of that set aside for any kind of emergency that might come up. But then, what does your employer provide? And go and take advantage of it. And if there's a match, you definitely want to take advantage of the match. You don't want to leave that free money on the table. That would be my advice to somebody that's just starting out.
That makes sense. So again, just to round things up here, we've talked a lot about 401k plans, but if your employer doesn't have a 401k, then what should these employees be looking into? What other options are there?
Yeah, so a great place to start, if you work somewhere, if you have earned income, but you don't have, for whatever reason, there's sometimes maybe it's a small company or something like that, and there's just no retirement plan available. Well, then you can do make contributions to a traditional IRA or a Roth IRA would be a great place to start.
Okay.
Great place to start.
And that's something, it'll be a lot more for another video, another week, because that's something we could completely dive into.
Oh yeah,
But,
yeah. Roth IRAs and IRAs, those are great vehicles, and a lot to talk about and unpack there.
Okay, great. Thank you. Was there anything else you'd like to add before we finish up the segment here?
No, I think I would just say it's never too late to start saving for retirement. Never too late. I would encourage anybody out there that's listening or watching, if you haven't done so and you think it's too late, it's not. There's always some way to do it, and so that would be my encouragement to people.
That's good.
Just find $50 a week, find $50 a month, and start saving for retirement.
It pays. Wonderful. Well, thank you. Well, Todd will be back with us here in the coming weeks and coming months. We thank him for being on the podcast today. And just to finish off John's pick of the weekly pick this week, last week or 2 weeks ago, we did Gideon's Ridge Inn up in Blowing Rock, North Carolina. So highly recommend that. But this week we're doing the sauna. The benefits of the sauna is really what I'm talking about here. It's something that I try to use regularly. As someone who's an endurance athlete, I've noticed that it really just helps just going a few times a week for 15 to 20 minutes at a time. It really just helps give me more endurance when I'm doing it. But statistically speaking, there's actually many studies that shown the Swedish that it's big in their culture. They use a lot of steam saunas. A lot of studies say that infrared saunas, for some reason, are the best ones because they dig deeper into the layers of skin versus a steam sauna. But anyways, if you go to sauna 4 to 7 times a week for 15 to 20 minutes, it reduces your risk of stroke by 60%, risk of cardiovascular disease just in general, like heart attacks, by 50%, and actually just the regular mortality rate of people who were consistently using the sauna was down 40%. Oh, wow. And this is versus people using the sauna once a week. So the comparison here is still people using it just slightly, but having that differential right there. So it has its statistical, scientific benefits, but also just personally, it makes you feel better. I mean, if you've had a long weekend of eating and binging and whatnot, it just helps clean out the system, make you feel better. Just does everything to clear out the pores and makes you feel fresh and clean again.
Good deal. Good deal.
Anyways,
we might need to go sit in the sauna after a bad market correction sometime.
Help clean out the whole system. Yeah, that'd be very needed.
Yeah.
So
very good.
That rounds it up for this week. As always, we like to finish off with our motto for Woodard & Company Asset Management Group: always buy quality and diversify. Thank you. The information provided in this podcast is for educational and informational purposes only and does not constitute investment advice, a recommendation to buy or sell securities, or an offer or solicitation of advisory services. It does not take into account your individual financial situation, objectives, or needs. Investments involves risks, including the potential loss of principal, and past performance is no guarantee of future results. Woodard & Company Asset Management Group is a registered investment advisor with the SEC. Please consult your financial advisor or tax professional before making any investment decisions.